Strangles and iron condors finding the right size balance. As market volatility and the possibility of market correction increase, traders seek to minimize their risk by improving their odds of success. One way to achieve this is by selling smaller deltas such as 10 or 15 deltas instead of 20 or 30 delta options. For example, 2 standard deviation strangles have a success rate of 95%, making them attractive to traders whose main focus is success rate. Kind of hard to read that bottom line, but let's go to the next slide. All they're saying is on the platform, there's a 1 standard deviation dotted line and then a 2 standard deviation line.
That is correct. That is correct. I talk about it all the time on my option trades today, my podcast.
Regarding success rate, both the 1SD and the 2SD strategies exceed expectations, but the success rate for the 2 standard deviation strangles is even better, closer to 100%. Well, on a percentage basis, I don't even actually know if that's that much better, but from a probability of profit standpoint, that's what they're referring to. So this is just straight stuff. We've done this 100 times. Theoretical versus real. Theoretical and then realized. Mm-hmm. Let's go next slide. So as expected, 2 standard deviation strangles have extremely high success rate. However, they generate a lower average P&L and a lower return on capital for each position. So just again, we're setting the stage. We're painting a little bit of a background here. You can see in SPY the 1, 2 standard deviation strangles, the initial premium, the average P&L, the win rates, and the daily return on capital. And you can see, the return on capital is pretty low. Win rates are pretty high. The average P&L is decent, and the premium is pretty cheap. Let's go next slide.
Win rate's great.
So what would the long-term portfolio performance be for both strategies if we simulated an equally sized account with 25% asset value allocated to each and managed at 21 days? From a portfolio perspective, 2 standard deviation strangles underperform 1 SD strangles by 27%. However, the strategy excels at volatility control. So, okay, now this is interesting because this is the question that we get a lot about, what is an expectation? What's a reasonable expectation of a return? So the reason that we put this up here is because on SPY strangles, if you sell 1 standard deviation SPY strangles with a very high probability of profit, in this case, I think it was 82%. Can you go back one slide for a second?
Cut to 97, 82 and 97 on a 2 standard.
82 and 97. Mm-hmm. Okay. So go back to the next slide, Beth. So with an 82% probability of profit, the 1 standard deviation SPY strangles annualizes with losses and everything else in there, comes out to about 13% with a 17% volatility. The 2 standard deviation strangle, the annualized return on capital is 9.5% with an 11.5 volatility, annualized volatility. Now, my rules. When we trade, we want to make some multiple of risk-free rates.
That's correct.
2 times risk-free rates or 9.5% is not good enough for me.
For the risk that you take, right?
For the risk that you're taking.
But what about if your risk that you were taking all the time was 80 to 97%?
Doesn't matter. It's all the same stuff. The numbers are the same. So 1 standard deviation strangle gives me a 13, because all the losses are built in here too. Mm-hmm. Gives me a 13% return, which is 2.5 times the risk-free rate. Neither of those 2 numbers are good enough. So what do you do? Now remember, we're only using 25% of the portfolio. So if we use 50% of the portfolio,
these numbers are going to be double or
26 and 19.
Right.
That works.
Sure.
So this is where the amount of money that you allocate matters, because that's what's built into these numbers. This is only 25% of your total portfolio. If you get to 50, those numbers are 5 times risk-free rates. Then all of a sudden you have something. Mm-hmm. So you have to figure out,
what's your risk tolerance? Yeah.
Well, sometimes we show you the most conservative case, and sometimes the most conservative case isn't the best case. Mm-hmm. The best case might be a more moderate or aggressive case based on where implied volatility is, especially something like now. Let's go to the next slide. So what about an iron condor? Iron condors are highly popular primarily for its ability to customize the amount of risk through adjusting the wingspans. And you can see here, we just kind of graphed it all out, and you can see from 20 deltas down to $1 wide. Let's go to the next slide, Beth. Theoretically, tight wings have some advantages. They're cheap to trade, they have a small max loss per unit, and they potentially can yield high return on investment. This is all true. But they have some problems. And let's go to the next slide. We might come back to this one. In reality, small iron condors have a lower probability of profit and narrower break-evens, resulting in a lot more losses. Yes, you're going to lose a lot more times.
Yes.
So small iron condors have a much higher volatility in P&L, which amplifies the gap between the expected and the actual return. When you look at the width of the wings, right? It's a tough way to eke out a living. Let's put it that way. It's a very tough way to eke out a living.
Now we're looking at 1 and 2 standard deviations here. You know, 2 standard deviations, you're going around the 5-ish delta option, right?
Yeah, but these are all iron condors.
I know these are iron condos. I was just going back because I'm getting emails from people like, you know, we were really looking, you know, we look at more the 30-ish delta option than the 1 and 2 standard deviations. We do go to around the 15-ish delta, which on one side might be standing, but not on both sides.
What's dangerous about this, what this slide shows that's kind of scary, is that the realized return on capital is extremely low on very small iron condors. And you're many times below risk-free rates.
But this is the quandary with smaller accounts too. You know what I mean?
I understand. We're trying to show that's
Yeah.
what we're trying to show. There's a reason for doing small iron condors, very narrow ones, which is you learn from it. It's tough to make a living. Also takes much longer for these less risky positions to reach their profit target, like 50% in this case. And that is correct. So the number of days in the trade, I mean, if you want to get to your spot, you've got to widen the strikes. That's all this shows. If you want to get to your spot, you got to widen the strikes. If not, on the really narrow ones, it's super hard, almost impossible to get there. Finally, when it comes to the percentage return, the wide iron condors give us more bang for the buck in the same amount of time. Yes, they're very close to the strangle returns. Not exactly, but much closer to the strangle returns. This is even $10 wide. Go $20 wide, you're close to the strangle returns. Again, what we're showing here is that there's 2 major takeaways from this. Takeaway number 1 is that sometimes you've got to go over that 25% number to like 50 or higher, especially in smaller accounts, to get a decent return. And the second thing is if you're going to do iron condors, you're not going, other than for engagement purposes and teaching, you're not going to do much with narrow iron condors. You got to go wide. Smaller delta strangles offer a high success rate and volatility control, but underperform in P&L and return on capital. Narrow wing iron condors are cost effective for beginners, but have a low success rate and a volatile P&L with limited profit potential. Iron condors are already capping your potential profits and defining your risk. So going too small with them is much worse in the long term compared to going too small with strangles. And while smaller strategies provide certain benefits, they may not always yield the best returns, highlighting the importance of balancing risk and reward and the amount of capital that you use. I cannot stress that enough.